Analysis of long-term assets. So what is a long-term asset? We've discussed earlier that on the balance sheet you categorize your assets as current assets and non-current assets. And similarly, your liabilities also are categorized as current liabilities and non-current liabilities. So what makes something current or non-current? For most companies, it is that if they are expected to be converted into cash within 1 year, that is what makes up your current assets. Or if the liability is expected to be paid off, settled within 1 year, then it is a current liability. Whereas if the asset is going to give you economic benefits for greater than 1 year, then that will be considered as a current asset, non-current asset. And if the liability is a long-term liability like long-term loan, right, then that will be a non-current liability which will be paid off over the course of multiple years. And why am I saying usually 1 year for most companies? Because most companies have an operating cycle of less than 1 year, right? So their operating cycle is usually less than 1 year. That is why current assets are and current liabilities are classified as those assets which will give economic benefits within 1 year and liabilities which will be settled within the year. For companies which build ships or aeroplanes, they of course might have an operating cycle of more than 1 year. So for them, there is an exception. Maybe you look at 18 months here, right? Because what is an operating cycle? The amount of time it takes a company to take the raw material, convert it into a product, and sell that product, get the cash for that product. So that is their operating cycle. Anyways, in this reading, we're going to be focusing on non-current assets, right? Long-term assets or non-current assets. And these long-term assets can be those which you can touch, such as property, plant, and equipment, right? So we will call these tangibles. And they will also be including patents, copyrights, trademarks, right? All type of things which you cannot touch, and that we are going to call intangibles. Now, the first thing we will be looking at is how do you value these intangible assets on your balance sheet. And this is something we have already discussed before, that capitalization of internally generated intangible assets is not allowed, right? There are very few exceptions for that, and we will talk about how IFRS and US GAAP allow the capitalization of internally generated intangibles. But if you are acquiring them, if you are buying them, then of course you can show them as an asset on your balance sheet. And we will talk about that in detail. Then we will move on to talk about the impairment of such assets. So for example, if you feel that you acquired them, and we've discussed this before when we talked about the Facebook acquiring of WhatsApp, where we said that okay, Facebook paid 19 billion for WhatsApp, right? And therefore there is this goodwill that they have bought, and goodwill of course is a intangible asset, right? It's a long term asset. Now, if the Supreme Court said, hey, Facebook, you cannot use the data of WhatsApp anymore to fine tune your advertisement, that means the value of that goodwill that they had purchased might need to be impaired, might need to be reduced, right? Or maybe even completely removed or derecognized. So we're going to look at impairment and derecognition of assets. Finally, we will move on to what is the presentation and disclosure requirement from a financial reporting perspective for both US GAAP and IFRS. And then how we as analysts can use the data that companies disclose and use it to analyze these companies. Especially we'll be bringing in some interesting ratio analysis over here. So let's get into this reading. Very, very interesting reading. So what are long-term assets? Anything that will provide you economic benefit more than 1 year. And I give you some exceptions to this, such as shipbuilding or your aeroplane manufacturing companies. But for most companies, the operating cycle is less than 1 year, and therefore anything which will provide you an economic benefit for more than 1 year will be classified as a non-current asset or a long-lived asset, which can of course be both tangible and intangible. So tangible is property, plant and equipment, something fixed, right? Whereas your intangible assets can include patents, trademarks, etc. Now there is one thing that I really want to talk about, which is the difference between goodwill and separately identifiable intangible assets, right? Separately identifiable intangible assets. So if you have like a patent or a trademark which you can separately identify that, oh, this patent is for a particular type of medicine for a certain disease, or this trademark is for a certain brand, right? Then that is something that can be separately identified, and therefore it will be specifically accounted for separately. But if you have something which cannot be separately identified, then that is what we will bring under goodwill, right? So first of all, this is one sort of differentiation I want you to make within this class of assets, that if you are talking about intangible assets that can be separately identified, think of stuff like patents and trademarks. But if Facebook is buying WhatsApp, right, and for whatever separately identifiable assets WhatsApp has, if the fair value of those assets, and I'm not talking about the book value, mind you, the book value can be on historical cost, but when we are doing such type of a business acquisition, we will first calculate the fair value of all the separately identifiable assets, which let's say was $500 million for WhatsApp, but Facebook paid 19 billion or 19,000 million dollars, right? So what is this extra amount that they are paying? $18,500 million. This extra amount that has been paid is not paid for any specifically separately identifiable assets, right? Whatever separately identifiable assets Facebook has, we calculated their fair value, and still Facebook paid $18,500 million more for what? For the goodwill of WhatsApp, right? So this is the concept of goodwill. And for companies that are, let's say, listed, right? Think of something like Uber, right? You can go and look at the share price of Uber right now, and look at its book value per share, right? Book value per share. Now, book value per share means what? That this is the value of its assets minus liabilities. So every company has assets, they have liabilities, and they have equity, right? And if you take, let's say assets are 100, liabilities are 80, equity is 20. So book value basically means assets minus liabilities is equal to equity. And if you have, let's say, 10 shares in this company, so the value of equity of 20, right, divided by number of shares will give you the book value per share, which is $2. And if the share price in the market, let's say, is $4, that means why is the market willing to pay more than the book value per share? Now, what I would suggest is, obviously Uber data is different. I'm just giving you an example of any random company over here, that if you take the book value per share and you compare it to the market price per share, you will find a difference. And I would suggest you do it for a company like Uber or maybe some other company that is your favorite. And if you find a difference in the share price and the book value per share, the reason is that on the books, the assets that are included are not necessarily all the assets that the company has. Now, there are a lot of assets which are not showing on the books, such as a company has a certain reputation, right? Maybe it has a trained and experienced workforce, right? But all of this cannot be shown on the balance sheet because, as we have discussed earlier, that internally generated intangibles are not shown, or not allowed to be shown under IFRS or US GAAP on your balance sheet, with very few exceptions, and we will talk about all those exceptions. But the stock market, develops its own economic balance sheet, which is different from this accounting balance sheet that they will be showing under US GAAP or IFRS, right? And in the economic balance sheet, of course, the market is going to be adding the value of its intangible assets which are not showing on the accounting balance sheet, and therefore the stock price will be different from its book value. Now, whenever you are going to have this type of a long term asset, two questions need to be answered. Number one, should it be shown on the balance sheet, and if yes, at what cost? And number two, how are you going to allocate this cost over the life of an asset? Now we will talk about two different situations. One where is a asset with a finite life, and one where there is an infinite life. And we've discussed some of these concepts before in earlier learning modules, but let's discuss them again. So let's say if you're getting a property, plant and equipment, let's say you're getting a new equipment, right? A new piece of equipment which has 10 years useful life. This is your assumption. And as a management, you are allowed to take this assumption or estimate as far as an accounting estimate is concerned. The management of a company is allowed to take this estimate, and based on that, let's say you paid $10 million for this equipment and you feel it will serve you 10 years, and using a straight line depreciation method, and of course there are other depreciation methods as well, but let's say we are using straight line, we will equally allocate that 10 million over 10 years, right? And every year we will book an expense, a depreciation expense of $1 million. So what is the cost to be shown on the balance sheet? $10 million. And this is the cost of the equipment, including all money that we spend on making it ready for use. That includes stuff like freight inward, and we've talked about this earlier. It even includes interest costs that can be capitalized if we are spending some interest on setting this equipment up. Right now, let's say it's an intangible asset. Now, let's say it's an intangible asset that we have purchased. Let's say like a patent. So we are Pfizer, right, the pharmaceutical company, and we have bought a patent of a cancer research medicine from another research company, and we paid, let's say, $100 million for this, right? Let's say we paid $1 billion for this, right? 1,000 million, and we only have this patent for, let's say, the next 10 years, which means after 10 years other companies will be able to use this medicine formula and sell that medicine as well. So we are only able to sell this medicine exclusively for 10 years. So what we will do is we will take that 1,000 million that we have paid, and we will say, okay, every year we are going to amortize this. So it's similar to depreciation, but because it's an intangible asset, the word we will use is amortization. So it will be amortized by $100 million every year, and in 10 years all that 1,000 million will be expensed out through amortization, right? So this is if the asset has a finite life. Now if the asset has an infinite life, and let's take the example of Facebook, or let's take another example. Let's say you have bought a brand. So let's say Pepsi has bought Lay's, right, which is a snacks or a chips brand for those of us who don't know what Lay's is. I'm sure everybody knows what Pepsi is, right? So Pepsi bought Lay's, and there's no life, there's no finite life to the brand Lay's, right? It could be used forever and ever. But let's say there is some propaganda and there is some news that comes out that, oh, Lay's chips are very bad, and Pepsi has to record a reduction in the value of this asset on the balance sheet. So let's say it paid $100 million for this brand, for the trademark Lay's, when it purchased it or acquired it, and it was showing as 100 million on its balance sheet, right, under non-current assets. But then let's say there is some bad news that, oh, Lays are very bad, or there's something wrong with Lays, and Pepsi has to record a reduction in this asset. That is called impairment, right? That is called impairment. It is not an expected reduction like depreciation or amortization. This is unexpected, right? Some bad news came out about Lays which was unexpected, and it is resulting in a reduction on the asset's value. This is called impairment. A parallel example would be like for the equipment that we were talking about, that there was depreciation going on, but if that equipment had some kind of accident, unexpected, then it would be impaired as well, right? So that is the difference between impairment and depreciation or amortization, that impairment is unexpected and it could even lead to complete removal of the asset from our balance sheet, and we will talk about that later. So, as far as intangible assets are concerned, the whole confusion is that IFRS and or US GAAP are both very strict when it comes to capitalization of internally generated intangible assets. Now, I know we've discussed this many times, but let me discuss this again with you once. And why do you think IFRS and US GAAP are so strict on this? See, I mean, if they allowed a company or any company to just show on their asset side whatever money they were spending on building certain internally generated assets, they will say, oh, I have made I've done this research, right? I've done this R&D and I've spent 100 million on it, and it's my asset, right? I mean, who are you to say that this R&D is worth 100 million? If somebody else comes in and pays you 100 million for it, then yes, we know that it's established fact that this R&D that you have done is worth 100 million. But you yourself cannot say it, right? That's why, as far as internally generated intangible assets are concerned, US GAAP and IFRS are both very strict on capitalization of this. There are certain exceptions, and we will talk about it, that in what cases IFRS and US GAAP allow you as a company to capitalize part of that development expense. But if somebody else is paying you for it, then definitely they will give you the cash for it, or whatever compensation that they are giving you, and you will give them that asset, right? And they, the purchasing company, and let's say that is Pfizer, which is purchasing a patent from a small cancer research company, right? So the cancer research company cannot show this asset on their books, but when Pfizer purchases it, then Pfizer can show it on their books. And what type of assets are we talking about? Patents, copyrights, trademarks. Think of Pepsi and Lay's, right, for trademark. And maybe just some customer list or some internally generated software that another company wants to buy. And it's very simple when we're talking about acquisition of these assets, because then you can just record them at cost, right? So if they are separately identifiable, which means easily separated, right, and under the control of the company and expected to generate future economic benefits. So think of Lay's, the brand acquired by Pepsi. Definitely it is separately identifiable, and once Pepsi buys it, then it will be able to control this brand, right? And it should help Pepsi generate future economic benefits, because then it gets into the business of snacks and it has a nice brand name to do it. So they are going to be recorded on the balance sheet of the acquirer, which is Pepsi in this case, right? But just two small criteria, of course, have to be met: that it will provide future economic benefit to the company, and the cost of that asset can be reliably measured. That what is the amount of money Pepsi paid for that brand, or what is the amount of money Pfizer paid for that patent. Now, therefore, the value or the accounting for the intangible asset really depends on how it is acquired. If it is purchased, then it's very, very simple, right? If it's separately purchased or acquired, then of course you know the price, and that price is of course the cost or the value of that asset. Very simple. If it was internally generated, right, if it was internally generated, then it becomes very complicated, because as you already know, many times we have discussed that very, very strict rules and regulations are there for capitalizing R&D. Research cannot be capitalized under any circumstances. Yes, development costs can be capitalized, but IFRS and US GAAP differ on how much and how. So we'll talk about that difference shortly. But what I want to talk about is another situation which is called business combinations, right? And this, by the way, is going to be discussed at a lot more detail at CFA level 2. But for the time being, just a little introduction to business combinations: that let's say a company is acquiring another company, or let's say Pfizer is acquiring Moderna, right? Now Moderna has a lot of different patents. It has a lot of different research going on. It's not that it has only one patent. If Pfizer was just separately buying one patent from Moderna, right, and paying one price for it, then it would be very simple to record that patent's value on the balance sheet of Pfizer. But if Pfizer is buying the entire Moderna, right, as a whole full combination of multiple patents, then it gets a little bit complicated. And for each separate patent, for each separate identifiable asset of Moderna, let's say patent 1, patent 2, patent 3, we will have to then come up with a fair value for each of those. And then if Pfizer is still paying extra, then all the fair value of all the separately identifiable assets, so then the remaining amount, of course, is going to be goodwill. Right. So now let's talk about business combinations. And of course, as I told you, that this will be discussed in more detail at CFA level 2. However, just to give you a little bit of an introduction, that what happens with business combinations is that you have to record each of those assets at their fair value, right? And there might be multiple assets, so then naturally it gets a little bit complicated, that what is the fair value of each of those assets, since we're not separately paying a price for them, right? And don't worry about it too much at level 1. Later we will get into that. However, the concept of goodwill should be clear for you, that if you are paying for a business more than the fair value of all its separately identifiable assets, then that of course is going to be goodwill. So if the purchase price of the entire business exceeds the fair value of all the separately identifiable assets, right, then that is the fair value. And here's a simple example, that Tan Hospitals is buying man equipments for 100 million. But the fair value of all the identifiable assets of man equipment are 95 million. So this extra 5 million is obviously going to be the goodwill. Now, situations other than business combinations, right? If you're just specifically buying a separate asset, right, buying a patent from an inventor, that is simple. You just take the purchase price and that will be assumed to be the fair value. So this is of course a simple situation, and we have already talked about this. Now the whole confusion will start with internally developed, right? This is complicated because, as a general rule, whatever research and development you are doing, the research cannot be capitalized, right? That's obviously no way that you can capitalize research. But development can be capitalized under IFRS, and some development, which is only software. Only software can be capitalized under US GAAP, right? But there is some more detail I need to tell you about that as well. And there is some more detail that I need to tell you about IFRS as well, because they want the technical feasibility has to be established. Now, what does that mean? That means that IFRS allows you to capitalize development expenses for software and even for other things like research on cancer research or whatever, right? I mean, IFRS just generally allows you to capitalize your development expense, but they are strict on the establishment of the technical feasibility. Now, US GAAP only allows you to capitalize software development, but there is some leniency in US GAAP. Now, the leniency is for internally software can be for internal use and software for sale. Now, IFRS obviously says that technical feasibility has to be established, right? And US GAAP also says that the technical feasibility has to be established before you can capitalize software for sale, right? What does this mean? It means that have you really developed something which other people, which third parties are willing to pay money for? That if you develop software for sale, well, is there anybody willing to buy it? Right? So once the technical feasibility is established that yes, people are willing to buy it, then you can capitalize it under both IFRS and US GAAP. Now, US GAAP is a little bit lenient on the capitalization of software for internal use. Now, of course, I mean, even everybody is surprised that where US GAAP is so strict on everything else that they are not allowing any capitalization except for software. But for software for internal use, they have this leniency that you can just capitalize it. But one thing I really want to emphasize on that we're talking about just the development cost, right? Only the development cost. Anything before the development, such as the initial research, cannot be capitalized. Anything after the development, such as selling it or any kind of sales and marketing expense, cannot be capitalized. Only the core development is allowed to be capitalized, even without the technical feasibility as far as internal use software is concerned. So the US has these leniency areas, and I believe there is a reason for this because, of course, the US is focusing on technological companies where they have a strategy to develop companies that have software, which is their main asset. So if they're not going to allow capitalization of software for internal use, then it will be very difficult for companies like Google and Microsoft and Facebook and WhatsApp to be created in a country like the US. So this is actually a good leniency. There are some other leniencies of the US that are coming to mind right now, and I would love to tell you about them. But of course, this is not the video. But if you're interested, you can look at the stock options valuation or the expensing of stock options, how US employee stock options, that is, how the US GAAP and IFRS differs to that, and that is also a very, very interesting area. Anyways, coming back to our internally generated intangible assets. The internally generated intangible assets research cannot be capitalized. Development, yes, IFRS allows you to do that once the technical feasibility is established. US GAAP only allows you to capitalize internally generated software, just the development cost. However, for software that is being developed for sale, the technical feasibility also has to be established, similar to IFRS, but for the internal use, you can capitalize even before the technical feasibility is there. Right. Now, if you are analyzing two companies, right, and one is capitalizing and the other one is not. So let me give you an example. Let us say that we want to compare the two businesses of LinkedIn as a social media with Facebook. Now, I know they're two very different social media platforms. LinkedIn is more professional and Facebook is more personal in nature, I suppose. But let's say we were comparing Microsoft versus Meta. Now, Meta is the company that owns Facebook, and Microsoft is the company that owns LinkedIn. And Meta generated Facebook internally, right? So Facebook is not something they purchased. They've developed Facebook internally. So this is internally generated. Whereas your LinkedIn, I believe, was acquired by Microsoft. So naturally, LinkedIn has been acquired, whereas Facebook has been internally generated by Meta. And if we are comparing these two companies, we will need to make some adjustments. Because if a company is internally generating, then they will be expensing the costs, right? They will be recording lower assets because they won't be able to record the asset that they are creating because it's internally generated, unless, of course, the US GAAP allows it and they do it. But naturally, if they are expensing it, then they will not be able to do it. So their assets will be lower, whereas the one which is capitalizing it, or it has acquired that asset and therefore is able to capitalize it, they will then have your assets will be higher, right? And as far as statement of cash flow is concerned, the one which is acquiring it, those cash outflows will be shown in investing activities, whereas the one which is internally generating is going to have those cash flows showing as operating cash flows. Let me give you another example. Let's say we are comparing Pfizer and Moderna, right? And let's say they are both trying to come up with a cure for cancer, right? And Pfizer acquires companies that have been doing research, whereas Moderna is going for internally generated assets or internal R&D. So naturally, Moderna is going to be expensing all this cost, which means they will be recording lower assets, whereas Pfizer is buying these assets, so they will have higher assets, right? And statement of cash flows, Moderna will be showing all that expense as operating cash flows, whereas Pfizer will be showing all that expense as investing cash flows. So hope that really helps you understand this difference. Right, of course, you have to be very, very careful with the two phases. Research phase is definitely not going to be capitalized under any situation. However, development can be capitalized, and that is something we have to look at in detail for the differences in IFRS and US GAAP. Right, so let's now get into that. And I've already told you about it, that IFRS requires technical feasibility, right? And then you can capitalize the development cost for almost any type of asset, but in US GAAP only software. And even US GAAP requires technical feasibility, but that is for software for sale. And US GAAP for internal use software has a soft spot, right? It has a soft spot. It allows capitalization without technical feasibility as well. So a very nice situation over here. Right, so under IFRS, research costs are expense, of course. Development can be capitalized if technical feasibility is there and intent to sell the asset is established. Now, yes, intent to sell the asset is established, or even for internal use, it can be there that you've developed something which you will be able to use to generate revenue. So even if you're not selling the asset, as long as money is going to be coming in, right, then you can capitalize it. US GAAP doesn't allow capitalization of research or development except for software development. Now, software for internal use, you can just capitalize it, but please look at the word, all development costs. So no pre-feasibility or no post-development expenses are allowed to be capitalized. Only the core development expenses of software for internal use can be capitalized, and for sale also can be capitalized, but here of course the feasibility has to have been established. Just to make sure you are 100% clear on this, let us try an example. So what I would like you to do is, I would request you to please pause the video here, try to come up with the solution, and then I will walk you through the solution. Okay, so hopefully you were able to come up with the answer. On the 1st of January, this cost is starting $10,000 per month, right? And ended in December. So clearly they have spent a total of 120,000. Why? 10,000 into 12 months, right? Now, what part of this will be capitalized and what part of this is going to be expensed? IFRS requires the technical feasibility, and that technical feasibility is only there by 31st March, right? So the first 3 months, which is your Jan, Feb, and March, the technical feasibility is not there. So from 120, I would say 30K will be expensed as far as IFRS is concerned, and 90K should be capitalized. Whereas US GAAP obviously doesn't require any kind of technical feasibility as far as internal software development is concerned, and they will capitalize the entire 120K. So let us look at the solution. IFRS is going to expense out the 30,000, capitalize 90,000, and US GAAP will capitalize the entire one. So that is fantastic. Hopefully you are very, very clear about this now. And I suggest you take a break. And when we come back, we will start with the impairment and derecognition of assets.
அபியூசிங்கா? இதெல்லாம் சொல்லாதீங்க.